We have with us Sridhar Sivaram, Investment Director, Enam Holdings, who has joined us. Sridhar, I'm just going to repeat what I heard from investors in terms of how the P-note mechanism works.
Right.
Now, just to repeat for the benefit of those who are not familiar with this product, the Indian tax authorities only know the FII or the brokerage which is handling or selling the P-notes. Now, as was explained to me by the market experts, investor A buys via P-note, say an HDFC share for 1,000 rupees. The next day, investor B buys another P-note for 1,200 rupees. The third day, the second investor, investor B, sells it for, say, 1,100 rupees. He has booked a capital loss. But for the tax authority, A, B, and C don't exist. Only the brokerage exists. According to them, you bought first at 1,000 rupees and you sold at 1,100. The principle of taxation is first in, first tax. Yeah. So for them, you have made a 100 rupee gain, profit. A capital gain, and therefore the brokerage will have to pay a tax on 100 rupees. But investor A says, I have not sold. Investor B says, I have booked a capital loss. So who pays? Will it be the brokerage? Now that is the question which the P-note product throws up. And if even there is 5% or 1% capital gain, the P-note as a product dies. That's what I was given to understand. Sridhar, on that note and with that preface, have we understood it right?
So
does P-note die?
So the understanding of P-note product in the market itself is very poor. So broadly what you have articulated is what the issue of the participatory note is. As soon as the taxation regime kicks in, which is a capital gains taxation, this product becomes very difficult. As it stands today, based on whatever they have announced, even from 1st April 2017, this product becomes very difficult, even with the grandfathering. Because if you buy post-April and then you sell it, say, in a week's time, your cost of acquisition will be taken as part of the grandfathering. So you don't have to pay tax, whereas the new investor may have had to pay tax. So all I'm trying to suggest, not to confuse people, is that with a capital gains taxation regime, the participatory note products becomes a very difficult product. So that is something which the investor who is participating or who's using the participatory note will have to keep in mind. The first in, first out is a big catch here.
Okay, Sridhar, at the moment, like we were discussing with Anuj, out of the $120 billion that has come through FIIs, about $33 billion is P-notes. That need not wind up, isn't it? Because they get grandfathering.
So so the big issue here is GAR. So according to me, the government has gone into great length to ensure that there is a smooth transition from a non-capital gains regime to a capital gains regime. The big question mark here is with GAR. The way GAR stands, it overrides everything. It's an anti-avoidance rule. Now, according to me, 90% of FIIs probably, I'm using the word probably, will fail the commercial substance test because it's very ambiguous. If you fail the commercial substance test, you don't get benefit of treaty protection, so no grandfathering, so no 50% tax benefit. Now this is ambiguous. So all I'm trying to suggest here is that the government has gone to great length to ensure there is a smooth transition. In my view, they need to do one more thing, which is to push GAR by 2 years. So if you push GAR from 17 to 19, all the efforts that they've done on the Mauritius and the other tax treaty benefits and ensuring that there's a smooth transition, the transition will actually be smooth. If not, just the fear of GAR, because it is a fear of unknown, and let's be fair, the way it has been drafted, it's going to be very difficult for most FIIs to fulfill those tests, and GAR actually overrides everything else.
Yes. Sridhar, good morning. Don't you think the market, the FIIs knew that GAR would be a certainty? At the end of the day, it was not an unknown devil. Now it was a known devil for last 2 years. Don't you think enough adjustments have taken place? And what we're talking about right now could be just a bit of a knee-jerk impact. And in the longer term, this is actually a big positive.
So I agree with you. So in the longer term, this is great that if we have certainty in taxation, that is great. Unfortunately, I don't think there is enough adjustments have already been made to this, because there was a hope that GAR will be pushed back, or there will be some sort of changes made to GAR. There were some calls which FII broking had done a month back with some people in the government. No assurance was given, but what was told was bring us specific cases and we will tell you whether this sort of a situation will work or not. All I'm trying to say is that the understanding of this whole thing and the gravity of GAR hasn't been well documented. It is known it will get taxed, but there was a general feeling that the government will come and step in at some point of time to ensure that GAR is not implemented. We've seen that in the past. I mean, GAR has always got pushed back because this is the big monster sitting in the room and nobody wants to take it head on.
Also, so your point is that FII investment P-notes may not be grandfathered. So the interpretation that it will die in April 1, 2017 is perhaps not correct. It will probably start dying right away because investors fear it will not be grandfathered. Is that right?
Yeah, so GAR was anyway supposed to come, as Anuj mentioned. So this was a known fact. Over the year, people would have taken cognizance of this and would have adjusted their portfolios, either move it directly or move overseas or do something else. With this announcement, my view is that given that government has gone to such lengths to ensure there is a smooth transition, my view is that if they can push GAR by 2 years, it will go a long way in ensuring that there is actual smooth transition and not just in paper. I know we saw some interviews yesterday with Shaktikanta Das also, and he sort of suggested that that is the intention. But if that is the intention, then it will be great if they can announce it today or tomorrow or in a week's time, rather than waiting for February in the budget. By then it will become too late because people would have to, adjust and make changes between now and say March. So I think if it is February, it's too late. And they will need to come up with a lot of clarifications in February to ensure that there's a smooth transition.
Also, there is this 50% concession as well, right? From April 2017 to March 2019, the Finance Ministry has said that you'll get a benefit of 50% reduction in the tax rate, but that will be subject to a limitation of benefits article. So you have to be a bona fide business located in Mauritius to avail of that 50%
So actually,
rate.
GAR overrides that also.
But do you see a lot of litigation because of this?
So just the fear of litigation or the assessing officer not taking cognizance of these amounts that have been mentioned there, given that GAR is so overriding, that I don't think these numbers really mattered. So because GAR, the assessing officer does have a lot of powers, and let's be fair, it's I think 90% of FIIs will fail the commercial substance test in the true sense.
So from a market standpoint...
So I'll just explain what he's referring to, because that's what market participants were saying. Now, grandfathering is available to, as he says, genuine investors. Okay. Now, why may a P-note fail the genuineness test? As of April 2017, anti-avoidance rule says, if you are going to Mauritius only to avoid tax, then I will not grandfather it. You have to pay tax. Now look at the P-note product. He is sitting in Mauritius, the brokerage. He has got one investor from London, one investor from US, one investor from Hong Kong, one investor from Sydney. Why are you in Mauritius? All these guys are from elsewhere and you're in Mauritius. You're coming to Mauritius only for the tax. So, anti-avoidance may apply over there. That is what Sridhar is trying to say.
Exactly, and that's why you don't come into, maybe you'll fail the test of that 50% and you may have to pay
So which is why GAR needs to be pushed by 2 years. I think so if the government really wants a smooth transition and that is the intention, and I would want to believe that is the intention, that in which case the government needs to just take cognizance of the fact that GAR can be a big hindrance to a smooth transition. All they need to do is announce that they will push GAR by 2 years and they want a smooth transition. This will bring them the smooth transition.
Okay, see, I have 2 points. Because this is, some ideal that you would like. Let's discuss 2 things because we don't have that at the moment. I have 2 issues. One is this futures market. Now, one interpretation from the market is that about 30%, 50% of the P-note money is actually ETF money, which find KYC a hassle. Now, the interpretation from one of the market men is that this will simply move to SGX. Okay. It will move offshore. So nothing will happen. Values or levels of the Nifty will not die. NSE volumes will decline. So who will lose? Volumes on the NSE will go down, and STT, which these guys may have paid here. So these are the 2 potential casualties and not the level of the Nifty itself.
So volume will be a casualty, because what you've also missed is that there are a lot of arbitrage players. We know of arbitrage players domestically, but there are arbitrage players, even the FIIs and some of the proprietary desks, they do arbitrage and they create a lot of volumes for the market. So you're right, the volumes will surely take a hit once the capital gains regime comes in. So that will be a second casualty to this market because of this. But I think it's a transition phase, and one will have to take that in the stride.
Okay,
All
let's
right, we
address
also-
the other big picture as well. We have Arvind Sangar also joining us now. Arvind, hi, good morning. Of course, we've been talking about this issue for last 15-20 minutes, and you would have heard the conversation that we are having with Sridhar. What's your first take? The SGX Nifty is indicating that we'll have a big gap down. But do you think this is a big enough issue to derate Indian market, or do you think this is more of a near-term noise than anything else?
Well, I mean, I think there are two different issues that I would say. One is the fact that the government has wanted to move from being a complete tax haven conduit to having some taxes. In that sense, I'm sympathetic to the government's viewpoint that they want to have some reasonable taxes on short-term capital gains, and that objective is unobjectionable. What I am confused about and what I'm concerned about is that in the way that things are drafted, it's not clear that the access to the market will not suffer. And that's important, right? At the end of the day, you want taxes, but you want as many people to come into the market as possible so that you're not driving people away because you're complicating the process of coming in. And that's where, how are you going to treat P-notes, whether that will survive this, or will those people be told to go away if they don't want to go through the process, the hassle, frankly, of going through registering, because I can access other markets without having to go through all that hassle. So, if you're destroying the P-note market and you're insisting that people come in and register to invest, you're going to lose some investors. And to the extent that, the futures market, how the tax treatment will be, is not clear, that, that'll be a problem because, again, in this market, shorting is possible only through futures, which are rolling every month. And if you're going to have to pay taxes on every month because it's short term, that's going to, disincent the futures market trading. So I think there are many things that are unclear, and I'm not sure how much input has been taken from investors to understand how to tackle these issues to minimize the disincentive for accessing the market while collecting a reasonable tax. And I think that's where the current, brief paper that we've seen so far does not meet the smell test enough.
Okay, well, let me ask that question to both of you then, since you all know how the FIIs, experience the Indian rules. Arvind, is it so difficult to come directly? Is it so attractive to go the P-note way? After all, KYC rules have been eased considerably over the last 4 or 5 years. Why would it be so difficult to come in a non-P-note route?
Well, we've just been going through some of the process ourselves for one of our funds, and what we found is, it's taken us 2 weeks of, supplying different documents, and it seems like, again, India uniquely, and again, I'm saying this truly uniquely, is my utility bill more than 3 months old? Does it have my name exactly the same way that is shown in the P-note application? If not, then it gets turned back. Is my signature notarized by the right person? All this, unnecessary. I mean, I guess at the end of the day, we'll jump through hoops to do it because we want to access the market. But, you're not maximizing the investors in a way that, in a global world today, using some common sense, the rules that the investment bank's ultimately responsible, and you don't have to go through bureaucratic, unnecessary nonsense, which frankly, India is pretty much high on the list in terms of the amount of hurdles to have to go to the market through the KYC rules.
Sridhar, you agree? That's strong words.
Yeah, so I've heard similar stories from some of the FII brokerage houses who've been helping some of their clients to transition, which is to open their FII account, that there are too many bureaucratic hassles, even though SEBI seem to have streamlined, but there are still unique documents which are specifically asked from India and not from many other countries. So I think I would share that view.
Okay. Arvind, so what's your view on the near-term impact on the market itself? I mean, if we do see a lot of, litigation, a lot of lack of clarity from foreign investors, how much money do you think could get pulled out in the near term, and what could the downside for the market be?
First of all, I don't expect litigation. I think there's nothing to litigate here. I think the government is in its sovereign right to do what it wants. But to the extent that the bureaucrats and the government officials don't fully appreciate the fact that you're making access somewhat more difficult, my sense is the markets will have to get that message to them, and the only way the message comes is when some investors express unhappiness by selling. So I don't know how much of a sell-off we'll get. My sense is you could certainly see, 2-3% pullback in the market. Beyond that, it'll be a question of, again, I think the objective, as broadly outlined, that we're going to introduce some kind of a tax. We're going to do it with a transition period, which will allow for some amount of grandfathering. All of that is very sensible. It's the rules when they get to be implemented where there's a lack of clarity, where it makes investors nervous as to, will they fall afoul of some rule or the other, and are the rules going to be more about gotcha in terms of getting investors to, you're in, you're out, you have a real business in Mauritius, you're just using it for tax avoidance. So it becomes all these uncertainties, and therefore I think the market is probably going to remain a little bit under a cloud, even though this is, 10, 11 months away. I think the market's going to be a bit of a cloud till we get a better sense of the government explaining that their objective is tax collection and not to create a new bureaucratic hurdle for investors to not have to worry about, how they qualify under Mauritius or not, and what parts of, is taxes applicable to futures versus stocks versus all this. So I really do think that the government needs to come back and clarify its intentions and how they're going to do it, because the worst thing we can have is tax authorities running amok with a set of rules written open to interpretation, because that's a nightmare in India. That would be an absolute nightmare.
Okay, you agree that we are going to see the markets under a cloud for a goodish bit? Or as Anuj says, since GAR was always known to hit on April 1st, 2017, this is just reminding you that it is going to come. This is not really changing the reality as of April 2017.
So I think, there will be some hit that the market will have to take. I hope the government comes and gives more clarification on this, so that some of the uncertainties regarding this is clarified.
But there is no uncertainty. It is very clear.
GAR is uncertain.
Okay, whether GAR will allow grandfathering of P-note.
If GAR applies, then this is meaningless. This then applies only to genuine investors who can clear the commercial substance test, and which is very few out of the entire FI number that you're talking about.
Your point is, government has to say whether P-notes clear GAR.
Whether P-notes clear GAR or whether other sort of FIs clear GAR, they cannot clarify for just one set of investors, so they'll have to clarify in general. So I think according to me, the solution to a large extent lies if they can push GAR by 2 years, because then the grandfathering works clearly. But coming back to the markets, I think the markets are slaves of earnings. So if earnings come back, it doesn't matter if there's capital gains or no capital gains. Unfortunately, that is the problem. We are seeing green shoots that earnings are coming back. But I still feel that the consensus expectation of 17-18% for next year is looking a bit stretched, and hinges a lot on whether rain comes or doesn't come.
What is your correct earnings number? What's your earnings number?
I think it will be closer to 10%. Yeah, and that's what we've seen in the past 3 years. I mean, every year we come up with the 17 or 18% magical number, and by the year end, I think even this year we'll clock somewhere between 0 and 5%. We haven't seen all the earnings.
Okay, Arvind, let me ask you the bigger issue here then. For last fortnight or so, we have started to see green shoots in economy with the kind of numbers that we have seen, and the Indian market is outperforming in big numbers compared to the MSCI Emerging Market Index or Asia ex-Japan Index. And I'm sure, at the end of the day, you invest in markets because you see growth there. Taxation, of course, could be a tailwind at best. Do you think, once this noise dies down, the outperformance will be back?
I think so. And I guess, frankly, I'm a little more optimistic on earnings growth in FY17 than your prior speaker was. I think that the green shoots that are emerging, we're seeing for the first time in several years, right? The demand growth in cement, in power, in electricity, and also in oil, autos, commercial vehicles, all suggest that bottom of the economy is showing a lot of signs of life, which should, if it continues, and I guess, again, monsoon is obviously an important step along the way, but if we have a reasonable monsoon, which we could have from a depressed earnings level, which is what, frankly, FI 16 was a relatively depressed earnings level, we could have a pretty nice rebound, and we could easily get double-digit, maybe even going up to 14, 15% earnings growth, with the back half obviously being the stronger part of that. But that's not a stretch, given that we've had 2 years of disappointments. And just as we've seen some fantastic numbers on commercial vehicles after having multi-years of disappointment, there's no reason that the broader market couldn't have a pretty decent, earnings year ahead of it. So yes, we're quite optimistic about the market. Obviously, as I just mentioned, and as I think previous speakers have mentioned, monsoons is an important thing to watch out for in the next few months to help set a backdrop, which could also then allow RBI to cut rates and provide further impetus to the market and to the economy.
Sridhar, what about
So
you?
if you, do I understand you right, Arvind? Today, if you get a dip, and if you get a dip in the next couple of days because of this cloud, you're a buyer?
Yes.
In what?
Well, it's going to be individual stocks. We have individual stocks that we like in a variety of sectors. I don't have, broad brush, but certainly, autos is one area where we're seeing life signs of strong life. So auto and auto-related companies would be an area of interest. Cement is another area where we think, momentum was strong in the first quarter, although April is a little weak. But we think, with the spending coming, there's opportunities there. But even in the, specific rural-based consumer stocks, there could be some opportunities. So I think the opportunities are in many individual stocks and in a variety of sectors. So we will be keeping our eye out to see where we get some chances if the market pulls back.
Okay. Sridhar, what about you? So far this market has been a buy on dips market all through the year. That's the best strategy that has played out. Would you advise retail investors to buy into the dip? Maybe not today, but if we do see a protracted dip over the week, would you advise buying?
So I would still advise retail investors to use the mutual fund route because it's going to be a very volatile market. It doesn't look to me as if this is going to be a huge return market. This is at best a 10% return market from here because a lot of the negatives are already priced in. But I just want to add one more point to what Anuj mentioned about India's outperformance. So only two markets which are negative year to date, India and China. So we've had recent outperformances. The emerging markets on an aggregate are up almost 10%, and markets like China, Russia, Indonesia, the fragile five, out of that four are up at least 20% plus. So this has been a market where many of the markets have actually been firing on all cylinders, and most emerging market investors are sitting overweight on India. So people are actually sitting...
You're as good as your last innings, right?
Of course, I completely agree. So which is why the earnings coming back for India is very important because people come to India for strong earnings growth. Once we get that, it doesn't matter, if there is tax or no tax, people will come and invest in India.
So sectorally, if people are looking to invest now, irrespective of the issues that we have, where do you see the highest amount of value?
So I would say financials because a lot of the pain is already there. It's well documented, over-analyzed, and you may have to, pick and choose your stocks there, but that seems like an interesting option.
Okay, well, that is coinciding with what Rajan is saying, that he expects by 2017 banks to be well provisioned. It's a very important statement, well provisioned. He's not saying the worst of NPAs is over, but he's saying they will be well provisioned for the mess on their balance sheets. But I want to get back to that micro point about volumes moving out. Both Arvind and you, first Sridhar, do you, futures, FII's volumes in the F&O market is fairly substantial. There is one estimate that says that 80% of the futures volumes is on the Nifty, either options or futures. Now that contributes by the sheer multiplication of the underlying, you buy 5 rupees of an option for a strike rate of 8,400, then you're actually multiplying 5 lakh because it's a 1 lakh unit. 5 lakhs into 8,400. So that's a large contribution to volume. If that moves out to SGX because, of what Arvind says, the access to India is becoming more complicated, what happens to NSE volumes and therefore what happens to NSE valuations? It's going to the market to list. And a lot of the IFCIs and the IDBIs and a whole host of listed stocks have got some value because of the stakeholding they have in NSE.
So
is there a danger, micro, to those?
So volumes will surely take a hit. How much we'll find out because this is an event which is going to happen only next year. But I think it's reasonably certain that volumes will hit because arbitrage volumes will come down, futures volumes will come down. With taxation, many of these products may not work. Anyway, P-note as a product may not exist. So in your individual capacity, whether you have enough leverage, because P-note also provides leverage to clients, whether that will work or not. So I think there are many uncertainties as far as that product is concerned. I think volume will take a hit. But I come back to my point that if we get good earnings, then many of these will fall in place because investors will want to buy a market which is giving you a good earnings, which results in good returns in the market. Okay. So I think the government needs to also focus on policy, on ensuring consumption comes back, better taxation, clarity in tax, and the rest will fall in place.
Okay. Well, Arvind, therefore, what kind of a low do you think the market can see?
Well, that's hard to say, assuming that the global macro environment remains favorable. I don't see more than a 200-300 point pullback on the Nifty, if that. Again, I'm assuming that the government will not come out with anything that is going to scare the market. And again, I think keep in mind that all of this is going to go into effect in April 1 next year. So nothing is coming at us right away. So the government has given enough time to prepare. And in the meantime, I think there's enough time for the government to clarify and create conduits for investors to come to the market without having to jump through too many hoops. And hopefully they will take that advice to heart as they reach out to investors and try to get feedback. So I think the market pullback is likely to be relatively shallow unless for some strange reason the government comes out and pours fuel on the fire, which I certainly don't expect them to. I expect them to try to clarify things and calm things down.
Okay, on that relatively optimistic note that the market correction might be shallow, we thank both of you for joining us and giving us your views. Thank you, Sridhar, and thank you, Arvind, as well, for joining us. So, the government has taken a very decisive and bold step to improve the transparency as far as the tax regime is concerned. But let's see, the SGX Nifty at least is indicating that the short-term impact could be high. 1.5